as we would like to start the session now. So welcome to this, at least for ICC, first of its kind, a summit on wealth management. We have galaxy of experts in the capital market and in the wealth space. These are all renowned names. They're who's who in their own way and in their own space, having very deep knowledge. And we at ICC really feel honored and privileged to host these experts with us. We would like to start with the lighting of lamp. May I request Ambassador Ajay Bisaria, President ICC, Mr. Agarwal, Mr. Jain, and all our speakers to kindly join for the lighting of lamp. Mr. Saluja, Mr. Mistry, Mr. Khemani, Mr. Bhargav.
सर्वकार्येषु सर्वदा ॐ गं गणपतये नमः ॐ गं गणपतये नमः ॐ गं गणपतये नमः
Okay, thank you. Thank you. With this, I invite Ambassador Bisaria to join us after the group photograph on the stage. Ambassador, kindly join us on the stage. President ICC, Mr. Agarwal, Mr. Nitin Jain, kindly join us on the stage. I'm sure next 2 hours, we are all going to enjoy, benefit from the deep and very exclusive insights which these experts will be sharing with us. Mr. Bisaria, Excellency, who is with us, he is again a renowned diplomat. He has served in some very, very interesting locations. His profile is already there on the screen. He advises several companies. He's an expert on policy affairs, foreign affairs, markets, and the economy. And we are truly honored to have you with us. If you'd like to start, may I request President of ICC to start the session with his welcome address. Mr. Agarwal.
Hi, good morning, everyone. Bharat Mata ki Jai. Distinguished guests, ladies, gentlemen, on behalf of Indian Chamber of Commerce today, I warmly welcome all of you for this insightful session on shaping the future of wealth management in India. It gives me great pleasure to welcome Mr. Ajay Bisaria, Global Advisor to Asset Management Companies, authors, and former diplomat. Sir, it is truly an honor to have you with us today. Thank you for coming. I would also like to warmly welcome Mr. Vikash Khemani, founder, Carnelian Assets Management and Advisor. Mr. Jigar Mistry, co-founder, Buoyant Capital. Mr. Rajesh Saluja, co-founder, CMD, ASK Private Wealth. Mr. Nitin Jain, CMD, Neo Wealth and Asset Management. Mr. Ashutosh Bhargav, Head Equity Research and Senior Manager, Nippon Life India Asset Management Limited. It is indeed a privilege to have you all here with us today. Over the past few years, India wealth management sector has seen a remarkable transformation. It has moved from being a product-driven to becoming a more client-focused and technology-oriented. Today, as we gather here, our aim is to explore how businesses, investors, and the financial institution can build strong, sustainable, and future-ready wealth strategies. In fact, it is a collaboration between the advisors, investment, and industry. India economic rise is well known, with the country on track to become as 5 trillion economy soon. This growth has given a significant wealth creation and fast growing base to the HNIs, ultra HNIs, along with the investment heavier in middle class. The key focus now is not to create wealth, but on managing it wisely and responsibility with a long-term prosperity. The major trend we are seeing in the rise of the family office, which are now focusing on purpose-driven long-term investments. They are playing a vital role in ensuring wealth preservation and growth across generation. At the same time, customized wealth management is becoming the norms. Investors today are well informed, tech savvy, seek personalized advice that align with their goals and values. They want portfolios that balance growth, sustainability, innovation, and with the least of the risk. Technology is also reshaping wealth management from AI, automation, blockchain, digital onboarding. These innovations are improving how portfolios are built, traced, and secured. We also cannot ignore the impact of global uncertainties, geopolitical shift, inflation, market volatility, and the political crisis. Any kind of the surprises which is in the global world also impact certainly to this investment market. In this environment, strategic wealth management is about more than return, and its resilience on the adaptability. As we begin today session, let us remember wealth management is not only about growing money, but also growing responsibility for our families, society, and the nation. The Indian Chamber of Commerce remains committed for promoting this financial literacy and innovation, responsible wealth creation. I hope today discussion will inspire new ideas and collaboration that shape the new phase of India financial growth story. With this word, I once again welcome all our distinguished guests, speakers, and participants for this insightful session ahead. Thank you.
Thank you, President. As we all know, businesses or the markets don't operate in isolation. Anything happening in India, globally, will also have definitely some impact on the businesses, the business sentiments. And that's how you need a very rounded view on how and what all factors in India globally impact the markets. And today we have someone who understands it much, much better than all of us. And I think we are truly honored to request Ambassador Shri Ajay Bisaria to please address us. Please welcome him with a round of applause.
Thank you. ICC President Shri Agarwal, DG Shri Singh, NEO CMD, my friend Shri Nitin Jain, ladies and gentlemen, namaskar, very good morning. I'm really delighted to be here today. The last time I attended an ICC event was more than a decade ago when I had come here to speak on the opportunity in Russia. I was at that time in MEA looking after the Russia desk, and that was an opportunity we were talking about of how Russia could open up and the Eurasian markets and so on. Today, of course, I'm especially grateful because you've given me a chance to escape the severe air of Delhi, which is an AQI of over 400. So great to be here in Calcutta today. What I thought I'd do is to start with the big picture and just zoom in on some of the issues that that concern us more directly. So I will speak in the next 20 odd minutes in 4 parts, talk about the global uncertainty, talk about India's approach in dealing with it, then talk about the impact it has on your business, on global finance, on global wealth, and then finally try and paint a base case scenario of how 2026 might look. And of course, then I hope to provoke you enough to be asking a few questions and so that we have an interaction. So to begin with, why this uncertainty? I think we live in a world between orders. And the bipolar order that we had from 1945 with the US and the USSR as 2 poles was a relatively stable one. It lasted from 1945 to 1990 when the Soviet Union broke up. And then we had a less stable unipolar order led by the United States. And that order also crumbled in a sense in about 2008 to take us to a space where we are between orders. We haven't come to the next order, and we have a lot of countries jockeying to be important in this order. So today we live in times of extreme flux. And, you know, every generation says they live in flux, but I think at this time we have a perfect storm of several of these disruptions coming together for nations, for business, for individuals. And these are technology. We have AI now, which is technology on steroids. We have climate change. We have geoeconomics, the trade order. And of course, we have geopolitics itself, which is the reordering of the world. And today, I think we have geopolitics, which is trumping all the other 3, because we have, in a sense, a revenge of geopolitics that we thought it didn't matter, that trade and commerce was more important. It's suddenly back. So in 2025, we've seen a huge disruption, and that is thanks to what I think can safely be called the Trump revolution. So we've had 10 months of Trump, and we've seen how it has reordered the world, the political order, the economic and trade order, the nuclear order, the transatlantic deal, and most importantly, the trust in the United States among its allies and partners has dramatically gone down. So I think we are seeing something quite revolutionary in today's times. Recently, I was on a panel in Singapore with a person who's called Asia's Kissinger, and his name is Kishore Mahbubani. And he talks about the magnitude of structural change in the global order that we are seeing, he says, is perhaps the greatest it's been in 2,000 years of recorded history. It's the Asian century. China and India are reclaiming the position they held in the 18th century. And it was a time in 1850 where India was about 17 to 20% of the GDP. We have that ambition once again when we talk of becoming Viksit Bharat, or having a GDP of, say, $36 trillion by 1947. That might take us to that number. And China has perhaps done it already, that in PPP terms, it is 19% of the global GDP by some counts. So it is a huge structural shift that is taking place in the long term. On China's rise, Kishore Mahbubani cites a number which says that in 1980, the European Union's GDP was 10 times larger than China's. That's when the reforms began. In 2024, the EU and China are approximately equal in size, and by 2050, the EU economy can be expected to be half of China's. So that not just reorders the economy, but also the relative power and the relative dominance of global geopolitics. Similarly, I think India has seen a more modest but remarkable turnaround, because in 2000, the UK economy was about 4 times larger than India's. Today, the UK is already behind India, as we've taken the 5th slot. And by 2050, the India will be expected in nominal GDP terms to be about 4 times larger than the UK. Of course, we have to remember the sobering fact that the per capita income is different. The British per capita is 20x India's, because our population is 20x theirs. Nevertheless, I think this structural shift is important to remember. Also, a US political scientist who has compared the Trump revolution with the other ones we've seen in our lifetime, which is the revolution of the Gorbachev's socialist revolution in 91, which finally ended with the Soviet Union collapsing. So that was a sort of failed revolution. And of course, the Chinese revolution from the 1980s, the Deng Xiaoping's revolution, which again reordered or started the reordering of the world. So what we had was the modernization of China. We had in the late 70s the Chinese Communist Party responding to China's underproductive, inefficient socialist system. And eventually, even the West accepted that change by accepting China into the WTO in 2001. And in a sense, while the Soviet revolution of Gorbachev had failed, the Chinese revolution succeeded because China lifted millions of people out of poverty and sustained nearly 10% annual growth for 2 generations to become a middle-income economy. So the Trump revolution, according to Ian Bremmer, is parallels these two, but the difference is that his revolution is primarily political. And the real enemies for Trump are those within, which is the Democrats and their supporters are identified as the enemies. What President Trump wants to do is end the checks and balances that stopped him from doing a lot of things in Trump 1.0, so that it becomes a different moment. Also, there is a bit of an economic revolution happening, which is very whimsical, very quixotic, where Trump has imposed the highest tariffs on the world, and mostly a tax on his own companies since the 1930s. This is the highest ever. And he's trying to undermine the Federal Reserve's independence. He is trying a bit of state capitalism because he's taken golden shares in US Steel, a 10% stake in Intel, a 15% cut of certain NVIDIA and AMD chip sales. But all these are ad hoc moves. So the real revolution from our point of view, or for the world's point of view, is the global governance revolution. What Trump has brought back are several elements of the law of the jungle, which is the 19th century world, which was a power-based world, and less of the 20th century world, which is the rule-based order world. So, in a sense, we have a hybrid order with elements of the power and sphere of influence-based world of the 19th century, and only some elements of the 20th century interdependence. And we have a style of politics and diplomacy, because the deals are done in diplomacy, like real estate deals in New York, and a lot of the diplomacy becomes reality television. So both the structure is changing and the method of doing business between nations is changing. Uh, Even before the Trump revolution, we've had a challenge to the global world order by several powers. And I would argue that the post World War order, which was a US led, UN defined order, a liberal Western order, it was sometimes called, was challenged by three powers in the last couple of decades. And these are Russia, Iran, and China. And what they did was, in this challenge, we've seen the expressions of this challenge in the two hot wars that we see in the European theater, the West Asian theater, but also in the Cold War, which has now started with China. So Russia invaded Ukraine in 2022. Part of the Ukraine war was a statement against this imposition on Russia of NATO or of US hegemony. And today we have a situation where even yesterday, Russia again attacked Ukraine. It's possibly winning the war, and it wants control over 4 territories in eastern Ukraine before it thinks of a ceasefire. In West Asia, we've seen this express itself through what the Israelis consider 7 Iranian proxies challenging challenging Israel. And what we have is a sort of uneasy peace right now, which will hopefully develop into a more permanent peace. But the most important, I think, geopolitical development from the world economy is the China-US Cold War, with US-China competition, which started in essence in 2018. So, and what we saw in Busan, South Korea last month, when Trump and Xi had a meeting, was more what we should call a tactical accommodation rather than a strategic reset or a move towards what is called a G2 world. This is more a world that will remain in competition. For instance, one of the rounds of the competition is in the scramble for critical minerals. Trump's has expressed an interest in grabbing Canada, Greenland, Panama, also getting a critical minerals deal with Ukraine. And all this is potentially to access China-free supply chains for critical minerals. He's also signed a $8.5 billion critical minerals deal with Australia. And essentially, the way Trump looks at it is that this is the battleground of the future. They should not let China control such large chunks of it. So what we have today is a world where different major powers, but also different organizations are writing different scripts of what could become the multipolar world order. So this is more a G20 world than a UN world. but everyone, the SCO, the BRICS, they're all writing a script of what they feel should be the sort of multipolar world. Another element of the uncertainty is across Europe and across the US, there's a lot of despair, there's a lot of anger at the status quo, there's a lot of fear, and we've seen a lot of anti-establishment movements gain, and the rise of far-right political movements. In a sense, what you see in the United States today is a far-right government, but we're also seeing this in Europe with the National Rally in France, with the Alternative for Germany party. And so these are very right-wing, protectionist, anti-immigrant movements. We've also seen some of this uncertainty expressed closer to home. If you look at the collapse of governments in South Asia, we've seen coups in Afghanistan and Myanmar in 2021. We saw Sri Lanka's economic meltdown in 2022. In 2023, we saw Imran Khan revolution in Pakistan that failed, that was controlled by the army. We also saw the uprising and change of government in Bangladesh in 24, in Nepal in 25. So what they have in this is in common is that they are youth-led anti-establishment sort of movements to topple seemingly stable governments. Is it fear and anger, or is there an involvement of a foreign hand or foreign agencies that find it useful? That is another question that is being asked. So all in all, we have a world which is being called, borrowing a phrase from the business world, the VUCA world, the VUCA world, which is volatile, uncertain, complex, and ambiguous. So how does India deal with this complex VUCA world? Now, India manages these four global transformations that we talked about in climate, technology, economics, and geopolitics, while taking care of three domestic transitions of its own. And these are, of the last 80 years, a democratic transition, which has been successful, a social transformation, which has been largely successful. But today, India focuses also on its economic transition. And what is that economic transition? To be in a position in 25 years of being a developed economy. That is a statist goal of the stated goal of a developed country. Today, the success has been partial. We have a rate of growth of 6.5% plus. India is the fastest growing large economy among the G20s and even otherwise. But still, the per capita income is 128th in the world at $3,000. So that is a cause for concern and a reason to accelerate. Now, this GDP has grown despite global headwinds. Because if you see, compare it to China's growth or the Asian tigers' growth in the 70s and 80s, they had the tailwinds of globalization with them. In India, manufacturing has not quite taken off. Agriculture is only 17% of the GDP. But the direction of reform since 1991 has been positive. They have to be negotiated in a democracy, unlike in China. But there have been several success stories. So the GST got us a unified market. The UPI got us a unified financial system. We moved to digital welfare, which was very successful in terms of the JAM Trinity and the direct benefit transfers. And what we've seen is massive infrastructure development, banking reforms, the NPAs coming down to 3.9%. But essentially, I think we have a situation where the Indian economy is prepared now to grow at the 8% trajectory for the next 25 years. And that is the stated political ambition of the economy. And how do we deploy the world, leverage the world to achieve this objective? So the core foreign policy idea that India has is that we move from non-alignment to multi-alignment. We have a situation where we engage with all the major powers simultaneously in order to benefit largely the Indian economy. And in his book, The India Way, Jaishankar, the foreign minister, summarizes this as saying, our policy is to engage America, manage China, cultivate Europe, reassure Russia, and while we are engaging with Japan, the global south, and having a sort of neighborhood first policy. But some people are arguing, of course, that we need to be managing the US more than managing China, because that is the current source of the volatility. So the kind of world India faces today is where both our major trade partners have weaponized that trade. So the United States is, which is our destination for our $85 billion of exports, has weaponized the access to that trade with tariffs, and China, which is our source of $100 billion of imports, has weaponized it in terms of the kind of curbs and controls that it places on particularly on critical minerals and critical supplies. Even Europe is creating environmental barriers. It has the CBAMs, which is the carbon border adjustment mechanism, and the deforestation regulations, etc. These are again barriers, protectionist barriers, more than genuine climate solutions. So, what are India's strategic objectives? What do you do when you are in a world like this? The first objective is to safeguard your security. Second, to have stable energy and commodity supplies. Third, to diversify global partnerships. Fourth, to reduce dependencies on technology, defense manufacturing, the Atmanirbhar Bharat idea. And the fifth is to increase your influence in global institutions. So, practically, what it means is that you try to maximize economic gains through multi alignment, through supply chain management, and through energy security strategies. The multi alignment is clear. We are dealing with the US for our defense and technology, for Japan for our infrastructure, Europe for our trade, Russia for defense and energy. And this hedging maximizes our room for maneuver in a polarized kind of world. Oh, the supply chain strategy, again, is to have production-linked incentives to, for instance, benefit from the China Plus One opportunity, to have a national manufacturing and technology roadmaps to strengthen our capacities in things like semiconductors, electronics, AI, defense, and renewable sectors. And then energy security. You've seen the whole battle that India had to fight with the United States on getting discounted Russian crude. Again, that is to, despite Western pressure, maintain those supply chains of energy. So let's take a closer look at the India-US relationship. I think because that is one of the most critical relationships that need to be managed. I think despite all the noise that we've heard this year, it is still the most defining relationship we will have in the 21st century. It has three long-term irritants which have expressed themselves this summer. These were the way we look at the trade, the way we look at the Indian imports of Russian oil, and the way India looks at US treatment of Pakistan, which for India is a major security threat. So what we saw this summer, I think, was basically the art of the deal for Trump, which according to his book is push, push, push until the other side blinks. And that is what he was attempting. He was trying to get a little more despite the several rounds of negotiations. But two geopolitical accidents delayed everything. We had a summer war with Pakistan where Trump tried to take credit. and that created a lot of bad blood between our countries. And also, the Russia war did not end, and India became collateral damage in putting pressure on Russia. So, what appears now is that the likely scenario is that we will get a deal in the next couple of months on a 15 to 19% tariff. The Russia tariff, the additional tariff, will be removed, but we have new risks on the horizon. So we have the Hire Act, which threatens taxing, which is being discussed in Congress, which threatens to tax all outsourcing at 25%, which will be resisted by the tech companies, but it's nevertheless there. And of course, you have therefore a tariff proposed on goods, on services of the Hire Act, and also on people with the whole H-1B visa tax of $100,000. So all these forces will remain, they will be debated in US society. But I think the big picture is that the US will continue to place a bet on India, even though some in the US, even in the MAGA right-wing system, say they would like India to bet on the US and join the US camp rather than maintain its strategic autonomy. But Trump personally does not see the world in strategic competition terms. He's more obsessed with tariffs and looks at the world more as a place where he gets his objective through tariffs and through sanctions. So I think this is the sort of situation that we face. I recently met a Trump advisor, and he summarized Trump's policy as saying that it's no longer strategic altruism. There was a case being made earlier by some of Trump's, the right-wing ideologues, that the US has to bet big on India without immediate benefits. It's strategic altruism. But today it's replaced by transactionalism. They want to know, what have you done for me lately? Not what could you potentially do for me in the next decade. So that is the game India has to play. And I think the overall strategy will be negotiate in the short term, accommodate in the short term, diversify your relationships in the medium term. You cannot trust the United States by the experience of this year. And in the long term, no option but to reform and strengthen our own economy. So I think that's how India looks at it. So let me come to the third part, which is, how does all this impact business? How does all this impact your finances, your wealth, global finance, global wealth? What is essentially happening is that geopolitical risk, which used to be at the periphery, is now at the center of many conversations in several boardrooms. In a more stable world, you talked of the known externalities of non-market factors like governments, regulations, technology, society. But today, the most important disruptor for a business, if you're sitting on the board, is geopolitics. And this has been sort of true for a decade, even before Trump. For instance, 216 of the Fortune 500 companies left Russia and Ukraine after the trouble started. This included IKEA, McDonald's, H&M, Starbucks, Volkswagen. So all these companies had to leave. Now, suddenly, if you have another bout of trouble in another geography, companies might have to just shutter off over a couple of days and leave. So that is the sort of geopolitical risk we face. In 2025 today, we see economic tools being used for geopolitical ends. We see supply chain reallocation, rare earth and critical mineral control. We see export licensing regimes. We see tariffs and subsidies all being used and weaponized. And we see a lot of concentration risk. For instance, we live in a world where a lot of the finance is concentrated in the United States, 70% of market capitalization. A lot of the manufacturing, more than a third today, probably half in a decade, is concentrated in China. And in technology also, we see between the US and China a sort of technology duopoly. Because at the one end of the spectrum, you have AI and the AI majors and quantum, which the US controls. The other, you have the energy transition technologies, the EVs and solar cells, batteries, which China controls. And both are fighting each other to get greater control. Europe is not in play, other major powers are not in play. So we have a situation where we today have a fierce US-China contest for economic power. We have tightening controls of the US, which we saw on advanced technologies, semiconductors, chip making. We saw all these were seen by China as attempts to slow down China's rise, and China struck back. We saw that last month with curbing exports of rare earths and critical minerals. This is what Trump said. They hold the cards, they hold the levers, and we will see more such episodes, even though you might see tactical accommodation in the short term. There's supposed to be two China-US summits next year. Also, global trade has entered its most turbulent phase, not just now, but with Liberation Day on 2nd April, where Trump promised he'd have 90 agreements in 90 days. He hasn't got there yet. It's just about 10 or 12 agreements. The other contestation is around crude oil. Again, we saw the US has pressured its allies to buy huge quantities of crude oil from the US. $250 billion a year is the EU pledge. Japan and the UK are making separate commitments. We in India are facing the tariffs. So we have a situation where the US, China are weaponizing trade. The EU is hiding behind uh, climate barriers. And we have, of course, ongoing wars and regional flashpoints, and a lot of attacks on infrastructure, for instance. Shipping lanes have been weaponized, insurance premiums, choke points, logistics. So there's a lot of economic warfare which is becoming a reality. And what are the strategies for dealing with it? I think these strategies apply to nations and to businesses. The first is strategic hedging, that you diversify when this order is fragmenting and becoming more complex. The second is perhaps an idea to create a dependency control, that you have a dependency dashboard as a country where you say that no more than 25% dependency on any single partner or any single strategic area, whether in energy, defense, trade, finance, technology. So I think this is a strategy that you would have. You would know that very well. For all of you who manage a financial portfolio, the advantage of risk diversification, but that would be true of a company, and that would be true of a country. So in an age where the US has weaponized tariffs and energy policy, the EU hides behind protectionism, the Chinese weaponize their industrial dominance and geopolitical leverage, the strategy for India would be to strengthen manufacturing, to safeguard strategic autonomy, and to secure its supply chains. So let me end by, for fun, giving you the base case scenario for 2025, and we can talk about it in Q&A. But I would say, if you ask me for predicting in a base case what would happen for the 45 days remaining of this year and in the next year, I would say, one, the end to the Ukraine war will come. Trump will be the major factor. The Alaska process will succeed despite the current surge. Two, we will get a clear West Asia peace deal. There will be peace in West Asia. Three, US-China summits, there will be two of them, will have tactical accommodation, but not a strategic reset, not a G2 between those countries. The Taiwan grab is unlikely to happen next year, but it is a distinct 20% probability that China does do a siege of Taiwan within the next 5 years. India-US bilateral trade agreement will be achieved, possibly even this year. We can expect a visit by Trump for the Quad Summit in the first quarter of 2026. We will get an India-EU trade deal, which will be a detailed trade deal. We will get an India-Australia bigger comprehensive economic partnership agreement, which is under negotiation. We may have a short conflict with Pakistan. Again, we can get into this in Q&A, but this is because we have a situation in Pakistan where it is internally controlled by uncontrolled army chief who has a great deal of hatred for India and uses terrorism as a legitimate weapon. So we may have a short conflict of the kind we saw. We will have more tactical adjustment between India and China and perhaps a liberalization of China investment, again, as part of the accommodation. And I think India will achieve that 7% growth this fiscal, perhaps followed by another 7% here. The next budget is likely to be a huge reform budget in land, labor, capital markets, and processes. And we hope we'll get to that 8 to 10% trajectory for the next 20 years. So let me stop right there and happy to take any questions. Thank you.
Thank you. I think excellent insights. You really gave the overview of how the world looks like, including India, and what it means for India and the Indian businesses. But I think the best part is you ended on a very happy note, doing a little bit of looking into future, and probably things will sort out and things will work out. But of course, as you rightly said, it's a very difficult situation complex where things will evolve, come up, and let's give a round of applause for the excellent interventions to the Ambassador Bisaria. We will now open for maybe 5-6 questions. Can we have the mics? Yeah. Please be brief because we would like to take many such questions.
Mr. Bisaria, thank you very much for the wonderful deliberations. I'm Professor Jayanto Mitro. I have a question for you, sir. When you feel India can touch Achhe Din in the lives of the common people, will it take another 25 years? Because still we didn't see Achhe Din coming in the lives of the common people. Thank you very much.
Should we take more and then you would? Okay. The next question will take 3, 4 and then we can, yeah, the mic there.
Thank you, Ambassador, for such a lovely, elaborate narration of the whole situation. 2 questions. What is driving US's pivot towards Pakistan as far as, this whole, it was a great relationship for going on for 2 decades, and suddenly you've seen a very sudden shift towards Pakistan, especially post Operation Sindoor. So we would love to get your insight. And secondly, how do you see now, as a fallout of that or a result of that, India is warming up towards China? So how do you see this relationship evolving given our backdrop? And, I mean, in an ideal world, you would want to see India, China coming together and, having a good relationship. But so how do you see that evolving over 5-10 years?
Maybe we'll take one more.
Yeah, thanks, Mr. Bisaria, for such a wonderful, deliberation. My question to you is that, see, what we have mentioned now is that if it's a terror attack, there would be a proportionate response. So by that, haven't we enabled, such kind of activities and get into those kind of situations which probably we would not like to do? So was it, the right thing to do on our part?
Yeah. Yes, madam.
Hello, sir. We have about 22 years to reach 2047, 2047. Would India be a developed economy by then? Is it a dream or an achievable target? If it's an achievable target, we would like to listen to a few words of caution from you, because it's not only sufficient to do things right, but it is very important to do not to the wrong things or the dicey things. India stands for trust, like you rightly said. US, the point of conflict, or even the common man, nobody trusts US. So brand India, what should be its critical success factors?
One last question, sir. Given the tactical accommodation between USA and China, as mentioned by you, what benefits India more? Multi-alignment or more aligned towards China? Somebody said, some economist yesterday was telling me that more aligned towards China would benefit Indian manufacturing.
Thank you very much. I think these are great questions. Thank you for listening with so much attention and engaging with this. So, achieving, I think, two of the questions about 2047, whether we can achieve what we did or what we hope to do, I think it's good to have that larger strategic objective. There are multiple risks to that story. Of course, there are. One of them is the north-south divide story, which is a risk. You have 7 states in the south of India, which have a per capita state GDP of which is 45 to 50% over the national average. And you have Bihar at $800, you have UP at $1,200, you have Tamil Nadu at $4,000, so a 5x difference. So I think that gap has to be bridged not by taxing the South more, but by creating more of an innovation ecosystem and more of a business ecosystem in the northern states as well. So that is a major risk that has to be mitigated. The social risk that you also reference, the divides that polarize our society, it's very critical that we manage them with our politics, with elections, and not let that be a drag on our economy. And I think that's will remain a critical challenge for us. On the US pivot to Pakistan, again, I think the part of the explanation would be the nature of this US administration. It is transactional. It is not strategic. And therefore, you give it a bunch of attractive transactions to the White House and you can turn them around. So this is exactly what Pakistan did. It got a couple of very good lobbyists, paid them a couple of $1 million a year, and they worked on the White House, and they got 3 or 4 good deals that came together. One was a cryptocurrency deal where a group called the World Liberty Organization was involved. There was also a counter-terrorism deal where they agreed to provide to the US certain kind of counter-terrorism activity that would help the US Central Command. There was also a bit of helping the US in terms of basing rights within Pakistan. That is not a disclosed deal, but I suspect there was a lot of military basing rights that were talked about. So all this came together along with a bit of flattery that we will give you the Nobel Prize. And that was a potent combination that got Asim Munir, the new Field Marshal of Pakistan, a lunch at the White House. And that, despite India's strong objections, is something that they did. So it was the unique nature of this presidency that did it. But again, this will be a short-term kind of arrangement. It won't be something that will last, because historically, the US and Pakistan have a history of getting into bed on various deals and then very quickly falling out because of Pakistan duplicity. So, that is the likely scenario there. On the India-China kind of accommodation, I would argue that it will continue to be a tactical accommodation. There is no doubt, and should be no doubt, that this is a strategic rivalry that we will have for the next 3 decades. The challenge is to manage that strategic rivalry in the short term because of our critical dependencies on multiple sectors. But for instance, one of the things that we could do is what our chief economic advisor had proposed in last year's economic budget. Is it a better deal than importing vast quantities from the Chinese to allow Chinese limited manufacturing facilities and FDI in India, which means liberalize the Press Note 3 regime to allow Chinese more investment. So I think we will continue to accommodate. It'll all depend on the border. Whether we get that peace and tranquility at the Ladakh border will be what will determine this. Again, on the terror attack, whether our posture has enabled terrorism, this is always a security dilemma. The reason why you say that every act of terrorism is an act of war and we will respond is to give a strong message to Pakistan of deterrence. That if you try terrorism in my country, you could lose 9 terrorist bases, you could lose 13 air bases, and the next time it could be even harder. You could lose Karachi port, for instance. But at the same time, when you have an assured response doctrine, that no matter every act of terrorism will have a severe response, then you also make it a little destabilizing. It can sometimes be a perverse incentive for Pakistan. And right now, I think what we are seeing is a spilling over of Pakistan's internal confusion. The army chief in Pakistan has just done a power grab with amendments to Article 26 and 27 of their constitution, which has completely demolished the judiciary and made all the other forces subservient to the army. He's also given himself, in the last couple of days, a 5-year term. So it is a power grab, and it helps the army chief in Pakistan to have a short war with India, because then it demonstrates that Pakistan cannot do anything without the army. So the people have to live with that army. So that's the complex challenge we face. We want to deter terrorism, but at the same time, we cannot completely eliminate it. On the last question was about the US-China tactical accommodation, whether India should be part of one or the other. Often, some geopolitical experts frame it this way, that the future will be about Pax Americana and Pax Seneca. So choose where you want to be. I think the choice India should make is that we will be a separate pole. We will not be part of either of these. We will accommodate both these partners, but we will not be part of either of these. And when and if this Cold War between the US and China becomes very severe, we have to choose, I think, the United States, the freer world, because the Chinese are less reliable than the Americans. And I think in the long term, it is a strategic rivalry within Asia, but neither is a completely reliable actor, as we have discovered. So the only choice is to strengthen ourselves and become that alternative pole in the world. We are already the 3rd largest economy. Let's also be the 3rd pole. Thank you.
Any last question from anybody before we close? Okay. Yeah.
Hello, sir. A very good afternoon to you and all our esteemed panelists. I just had one thought in mind, which I thought that I can place in front of you. Gold and dollar have normally enjoyed an inverse relationship. Now, the recent surge that we have seen in gold prices, is it actually driven by market fundamentals or just the geopolitical uncertainties? That is one area where I would like a bit of a comment from you. And also, how do you see the gold dollar proportionality going forward? Thank you.
I think Nitin is better qualified to answer that. But I stuck therefore with geopolitics. There is a lot going on the economy. I would only say one broader geopolitical thing before I hand over to Nitin is that gold and the surge in price in gold is an index of the fear of uncertainty, because you're moving towards assets with real value and away from currencies because you become very fearful of the kind of world the dollar is presenting, and particularly with $38 trillion of debt and no real assets backing it. So I think that is one of the factors that will be at play. But I'll defer to Nitin's view on this.
No, thank you, Mr. Bisaria. Actually, what gold and silver have witnessed a phenomenal run, right? And it's no secret that it was not this time run by the retail and the HNIs buying gold, but it was largely scampering by the central banks. So I think the correlation that we are used to, I think a lot of them have broken out simply because of, I think, the revenge of geopolitics, if I can borrow the phrase. I really think the next 8, 10, 15 years, the world order is going to change dramatically. And we will have to start thinking about the future in a very different framework than what we have seen in the past. So I think a lot of other commonly held beliefs on investing and businesses will be changing. So this is just the beginning of something interesting that's going to happen. Thanks.
Since we are running a little late, so we would now request Mr. Jain to also do the vote of thanks.
I must say that it's always a delight, Mr. Bisaria, to have you speak in front of us. And this time it was no different. In fact, when you were speaking for a large part, I had become very pessimistic. And I'm very glad that you ended on a very, very optimistic note. So thank you for that. But such an honor, such a privilege to have you here. And thank you so much on behalf of the ICC. Thank you.
Thank you. And before we close, we have a small token. I'll request President to please present the token to our guest speaker, Ambassador Ajay Bisaria, and also to Mr. Jain. So Mr. Agarwal has to present to Mr. Jain. Thank you. So maybe you can take a group, you can just take a group photo and then we can end. So let's end this panel with a round of applause to all the experts. And there is no break. We are immediately starting the next panel. Thank you. Our next panel is equally exciting because we have 4 renowned experts They have traveled all the way from Mumbai to be with us, and they have wealth of knowledge with them. I think in half a minute we'll have the changeover done, and we will be starting our session immediately. There is no break since we want to continue. The insights which we have gathered actually help us evaluate the market, the offerings, the options to invest, and makes us a little more wiser in terms of how these things can impact your own wealth and your own investments. In the first session, I was just listening to different keywords, and I found 4 or 5 keywords, and I think T seems to be the common one. We spoke of technology, tariffs, trade, of course, terror, and on top of it, you have Trump. So, on this note, let's start. I'll first invite the moderator, Ms. Devina, to please join us on the stage. Let us welcome our experts with a round of applause. She is the India Business Head of Neo Asset Management. I will now invite Mr. Ashutosh Bhargav, Head Equity Research and Senior Fund Manager, Nippon Life. Mr. Vikas Khemani, Founder, Carnelian Asset Management and Advisors. Let's continue to welcome them with a round of applause so that Mr. Jigar Mistry, co-founder, Bind Capital. Last but not least, Mr. Nitin Jain, CMD. He is not there. Okay, fine. So you are there. I think we can remove one chair. So we'll have Mr. Rajesh Saluja, co-founder and CMD Ask Private Wealth. So let me now formally request Ms. Devina to please take over and conduct the session. Over to you.
Thank you, Dr. Rajiv. And thank you everybody for being here this lovely afternoon. And we have some of the leading industry experts with us this afternoon. So I think it doesn't get better than this panel to give us a deep insight into the industry and into the wealth management industry, which is now at the cusp of something really, really big. So today we'll be touching upon, obviously, the concept of family offices and how the wealth that they have created so far, how does that convert into intergenerational sustainable capital? We will be talking about investment ideas and philosophies and strategies that investors need to adopt and what they need to look at from a risk perspective going forward. We will look at what technology and AI and the influence that it is having in today's investing culture. So all of that and more. But welcome everybody. Thank you so much for joining us. So I actually was listening to Ambassador Visaria, And, he mentioned VUCA, which is volatility, uncertainty, complexity, and ambiguity. Sorry. So let me start with that. In today's market, and with all these factors playing out, how does one start an investment journey if he's a beginner? How does one continue to maintain if he's already been in the market? Maybe probably somebody who's entered post-COVID and he's never seen a downside, and someone who's seasoned enough to be in the market over cycles. So let me start.
So, hi. I think the mantra is diversification. I think what happened post-COVID, whereas for first 3-4 years, people made tremendous amount of money in equities, and inadvertently, I think the allocation towards equity in individuals or families, overall asset allocation have become very high. In last 13 months, markets have not gone anywhere, right? And it's a good reminder that, we should not focus ourselves only to one asset class. Yes, equities perhaps is the best asset class from medium to long-term perspective. But asset allocation has always been the key, and this is one way you can handle this whole VUCA world and the era where we are living, where not only the geopolitics, but there are many other disruption, technological disruption, and across sectors that we are seeing. So I think asset allocation is the way to the future. It got lost in the last 3-4 years, and I think it's a good time to revisit that.
Because, I was reading your article about investing and using optimism and pessimism perspective to investing. And typically, pessimists are considered well-wishers. Could you elaborate a little bit more about that in today's market context? Why would you say that? And how does that impact investing?
No, I think, see, if you see, generally speaking, and there's a very nice saying, it's a human psychology, or because the way it goes back into the human instinct of survival, right? So risks are always which attracts attention. So if I were to write an article that markets will fall 50%, everybody want to hear. But if I were to say markets will go up 50%, I think, okay, because what's big deal about it, right? So that's how it is, right? So, and like you mentioned VUCA, right? I think VUCA is not a new term. So at least I say in my career of 30 years, I've never found that when there's no risk around. There's always some of the risk around, right? So the only way to manage risk is to understand the risk and manage it, right? I mean, there's no other way. And to understand what game you are playing. The problem comes when you don't understand what you're doing and you end up participating. I have never seen when there's no risk around. So I would say, when you manage money, when you manage understanding risk, when you say, when I was saying that optimist versus pessimist sees the world that everything is going to come to an end, and accordingly deals with the investments and the risk and all. And the optimist sees that yes, world will progress from here, which is always the case. If you see humanity, it's always progress, right? Now, within that progress of the humanity, how do you find opportunities, understanding the risk, right? Let's say example, we know that world is very uncertain today. Everywhere, Ambassador also highlighted, we are a multipolar world. Again, kind of Cold War kind of situation has come about. Post-World War, we have lived in a very long period of stable world, and that seems to be challenging. But within that, if you see what India has done, India has strengthened itself, right? Same VUCA in 2011-12, when India was not strong, put us into fragile 5 economies of the world. Today, a similar kind of VUCA situation is there in the world, but India is not fragile 5, because in last 10 years, India has repaired itself structurally, be it our current account deficit, be it our fiscal deficit, be it our banking system, be it our inflation management, be it our debt to GDP, corporate debt to GDP. So we have repaired a lot of structural fault line of the economy. Now, of course, if the world falls apart or something goes around the world, it's not that we will remain unimpacted. But if that were to happen, we will be relatively far more insulated from the situation around. And that is what one can do in the context of its own portfolio, its own wealth management. That should things turn bad, how do you how does your portfolio do? So I think everything goes back to basics. So I don't think one should carry too much perception of heightened risk. Risk has been around, risk will always be around. It is about understanding the risk and managing it.
So Jigar, then in that case, would you then, considering your investment philosophy, many people say time in market is better than timing the market. So does that cater to the risk element, saying that, okay, there is risk, but it is time-bound risk. It comes at points in your investing journey. And therefore, sitting it out is the best way of doing it.
Quite the contrary, Devina. So, good afternoon.
I know, that's why I asked you, because I wanted to understand the other side of your thought process.
Good afternoon, everyone. So, I'll start with an interesting statistic. So, say you are an investor in the Indian markets for the past 25 years, you would have seen close to 9,000 trading days. If you manage to miss just the top 10 trading days, your portfolio returns would come down by 57%. Right? If you manage to miss on the top 30 trading days, your investment returns would come down by 87%. So clearly, setting it out in a country like India is not really an option. We need to see two, I think, important things, whether we are Japan circa 87 or not, in which case you would have seen a flat line for the next 35 years. But if you look at the fundamental fabric of India's economy, I can jargonize it and say, labor force participation and productivity gains, or more number of people working and people working more smartly. For the next 20 years, India has a huge lead up. In that scenario, I'll concur with what Vikas also said. Managing the risk becomes a much easier proposition than setting it out. I would also agree to what Ashutosh said, that post-COVID, investors have seen a certain cycle play out. If you are, say, looking at just the market cap indices, and I'm bringing it back to home when we're talking investing, small cap index has been up 5x, large cap index has been up 1.5x, and many people would want to believe that small cap is the only way to sustainably generate your wealth. But if you zoom out and look at, every time a 5-year cycle has ended, or every time a 10-year cycle has ended, the returns on the large cap and the small cap index are exactly the same number, right? Like you can round it off and take sort of split hairs, but essentially they are the same number. So rather than sitting it out, at least the way we do it at Buoyant is just to manage the risk through cycles. When things are great, you make merry, but then try not to get sucked into the entire debate. So, yeah.
Rajesh, from your standpoint, obviously, you have a lot of clients who are big equity investors, and they've made their wealth through equities. So in terms of advising, in terms of probably now starting to make sure that their portfolios are aligned to make sure it's more sustainable and intergenerational, rather than, they had their initial run, they made their wealth, now it's time to keep that wealth. So asset allocation plays a big role in that. And obviously, there are newer strategies, newer segments which are now opening up, which have sort of become more essential to a client's portfolio. So how are you advising clients? How are you looking at the current market to say that, okay, it's not just equities, or it's not just pure play fixed income. There are other things that are now a necessity in your portfolio.
Right. So good afternoon, everyone. So everyone spoke about risk.
And obviously balancing that.
Of course. But most of the time, risk is what is unknown rather than what is known. Most experts feel that if you look at all that has happened over the last so many years, we probably had not thought that they will come into play ever. But having said that, all the data points tell you that if you've just stayed invested over a long period of time, you've been able to deliver fairly good returns on your portfolio. So as a wealth manager, more than anything else, for us, it's about managing behavior of clients and temperament. Very tough to do, but the principle of asset allocation always remains that you don't over-invest in a specific asset class. And that used to be a trend earlier. Either people were heavily invested in real estate,
or people were invested in gold or too much in fixed income. And we've seen clients, their maturity levels on asset allocation change quite dramatically. I think the concept of asset allocation, like even in politics, India cannot be aligned to one country, or somewhere they're strategically aligned, somewhere tactically aligned. It's important from a diversification standpoint, even on a portfolio, so that you can manage unknown risks that come in from time to time. So from a wealth management standpoint, it's behavior. We've always believed there are three things that deliver returns. One is knowledge, the second is discipline, and the third is temperament. Discipline of asset allocation and not getting carried away. Knowledge about being invested in something that you understand. And temperament, which decides 90% of client returns, is how you behave with your money during good and bad times, or during periods of volatility, or various situations that come in from time to time. So when we design portfolios, there is a core portfolio which can be called a safety pot. There is a compounding portfolio where you can enjoy compounded returns over a period of time. And then there is a dry powder or a tactical portfolio that always waits to take advantage of opportunities that come in from time to time during all the market disruptions for various reasons which are not in our control.
Currently, what would you say is the one big shift that's happening in the wealth management industry? Obviously, the fact that technology is going to be playing a major role. There's like hyper personalization for clients' portfolios, which technology can drive. Reporting, digital onboarding, we spoke about everything, just makes a client's life that much more simpler. So how is the wealth management industry coming together, integrating this to provide the most value-added solutions to clients?
Two types of changes. One, client behavior. Across client segments, you have ultra HNI, and then you say the mass affluent. The needs are quite different. In the ultra HNI space, there is a trend of moving away from traditional equity investing into private alternate kind of investing. So that forms 10 to 15% of client portfolios. The second big one is really getting down to succession planning and estate planning, because most promoters over many cycles have understood there's always a risk in their own business. Single business concentration always carries a risk. So how do you separate family wealth and business wealth, so that if there are different cycles or different situations in the business, you have a financial portfolio that can be taken care. So creation of trusts, looking at various structures on creating liquidity and ensuring that the next generation carries on, is a big trend. Within the wealth space, technology currently is being used in two areas. For us specifically that are focused on ultra HNI and HNI, it's largely about improving efficiency and productivity. How do you ensure that your relationship manager can focus more on relationships, and many of the administrative work or analytics, etc., is taken care through technology. Nudging clients, nudging RMs on portfolio decisions, onboarding. A lot of administrative work gets taken over through technology. But in the mass affluent segment, technology is also being used or is being created to offer advice to clients and take away the concept of having a relationship manager, which is not very easy in India as a cost model, to cater to a large number of client segments. So we've got a long way to go, but artificial intelligence is clearly getting integrated in the way we manage client portfolios.
And is that, Ashutosh, an opportunity from an investing standpoint also? When you look at these kind of new age companies that are coming up, that are offering these kind of solutions, which are the next, has decades of runway to growth.
Yeah, so the total addressable market and new segments which are being created, I think there are so many sunrise segments which are there. The only challenge as an investor is that in this whole process, how to value them, such growth companies, right? There are certain debates around the recent IPOs, for example. So yes, I think the market is big and new businesses are being there, and tech has been a great enabler in terms of higher growth rate, and but the key would, as I said, would remain valuation, and there will be some many companies would come when a new theme comes, for example, the tech-driven new theme. And not everyone will survive, right? Eventually, the sector consolidates. So, as an investor, it's not only identifying the theme, you have to understand the micro of the sector, the competitive intensity of the sector. And like these companies, as investors, we also have to learn. There's a whole cycle in front of us of learning, how to understand these businesses and how to value them in the future. So I think it's all evolving for everyone, I think, in the whole ecosystem of capital markets. Yeah.
Because Rajesh highlighted a point where he said that now alternates are, something that is advised to every client, because maybe that is the space which is now growing. I mean, you've got 13 lakh crores of AUM under AIFs at this point in time. So that is a force that you need to reckon with. Compared to pure play mutual fund investments, even for example, equity alternates, how much importance in your scheme of things would you give to investors and how investing in the alternate space particularly?
So I think it's a part of a broader wealth creation cycle of any nation. If you go back and visit, India is going through very much similar transformation what US went through in the late 70s, early 80s, and over the next 2 decades, right? So whenever a nation creates wealth, the first part of the wealth, like if you see India's cycle, large part of the wealth was earlier invested into real estate. And then from post 2000, when mutual funds started becoming, that industry started becoming bigger and bigger. And so as the wealth prosperity increases, wealth sizes increases, the need of the investors starts getting different, from plain product to, because risk understanding goes up, risk opportunities come about differently. So how do you tap into those different risk reward opportunity? That happens through the alternative channels, right? Because you can't tap that through the standard plain vanilla mutual fund. So as a result of that, if you see in last 10 years, the alternative industry is only getting bigger and bigger and growing at a very rapid pace. So it is very much tied to the prosperity or wealth creation cycle which India is going through. And it is only a beginning of a very, very long trend. Because as India creates wealth, today our GDP is only in around $4 trillion. And if we get to $8-10 trillion, the overall market cap will go to, $10 trillion versus, and plus economic, the credit size and pool of capital, everything will go up, right? I remember when I used to go to US in 2000s, we saw we used to see family offices $1 billion, $500,000 billion, our jaws will drop open saying, my God, such a big family office. But that today, we're beginning to see in every city in India. I mean, every city has family offices with $500 million, $1 billion, and $100 million. To kitne hai, pata hi nahi hai. So I'm saying the size of the wealth is getting bigger and bigger, right? And many more people are getting richer in India. And as that happens, you need to have, so heterogeneity of investor increases, so does the need of heterogeneity of the products. And alternative space, according to me, will become probably 10, 20, 30 times more than what we are today. So I see that way. And today also, within alternatives also, there are only very few products. I mean, structured credit has just begun. Real estate has, real asset opportunity has just begun. REIT, InvIT has just begun, right? If you see the size and scale of, organizations like Blackstone and, KKR, how they have pivoted over the last 20 years in US, same thing will, according to me, get repeated here, over next 10 to 20. So I see alternatives as, from that lens, that it's a humongous opportunity in front of us.
Jigar?
Yeah, I would tend to concur. How can I not, right? We are part of the same alternatives industry. Only thing I'll add to what Vikas said is that, for a mutual fund, it is pretty much one size fits all. And if sort of, we listen to the ambassador on how things are evolving, see, if I look at equities as an asset class, the first 20 years since India sort of liberalized, or say early 2000s, there was a certain pattern to growth. Companies, so economy grew after liberalization, companies grew, but foreign investors were singularly driving that space, right? And there was a way in which sort of you interact with a country when you are operating from a distance. Post-COVID, so until COVID, some 1.5 crore people opened Demat accounts. Post-COVID, 6.5 crore people have opened new Demat accounts.
I was just seeing the numbers. It's like 25 to 30 lakh new demat accounts every month.
Yeah, exactly. And so then these people, have a lot of information. They don't have a lot of insight that goes with it. And they think that, okay, if a thing has happened in a certain way, it will keep happening in the same way rather than seeing the bigger picture. And, I agree that that will eventually evolve. But, with mutual funds, size becomes a constraint. I think that's where people in the alternative space, we can control the speed at which we want to grow, state out an objective which we are out there to achieve. As Vikas mentioned, create as many products as we want to achieve different objectives.
Limit the size so that your returns
Yes.
don't get impacted.
See, the question of capacity, Devina, in India is not something that is debated a lot, but it should be. Because every, strategy gives out at a certain size. They can be different if you're running just a small cap fund versus different if you're running a flexi cap fund. But that needs to be debated. And that's, I think, where the true alternatives framework comes into place.
In fact, Ashutosh, then, come in on that challenge that mutual funds will face because, SIPs are not stopping.
Yeah.
Then what is it? Are we going to start looking at SIFs more closely? I mean, there are going to be more and more innovative products that come along the way.
In fact, I would just slightly differ with what Vikas was saying and what Jigar is saying. I think in the last, say, 12, 15 months, whatever regulatory changes that have happened or taxation-related changes that have happened, the advantage has started to go back towards the mutual fund. So think of India as a country where you won't find many examples in the world where anything which comes with the word income, for example, right? Fixed income, salary income, dividend income. And anything which comes with equity, they are taxed at a very different rates. So equity, for example, is taxed at 12.5% as long-term capital gains. And the marginal tax for even an FD or any fixed income product is at 39% plus size. Right? There's more 25% gap. Now, do it yourself. Asset allocation is important. We started talking about it. But if you don't do it in a mutual fund construct, this whole asset allocation become very tax inefficient. Now, after July 2024, in the bundle called multi-asset allocation fund or asset allocation fund, even up to 65% equity, if you keep in a bundle, right, for your clients, right, that would attract 12.5% taxation. While if you try to do as wealth manager or as a firm where you are trying to pick even the best managers for each of the asset classes and making a solution, the tax efficiency is not there. So I think mutual funds are actually getting advantages. Other part about the SIPs, I think is very clear. I think equity cult is here to stay and masses will keep putting money. Same issue here, that taxation for fixed income has become very unattractive. Therefore, the tolerance for valuations have also come down, right? Or rather, it has gone up, right? So more and more people would put money in equities because on a post-tax basis, there is nothing which is more attractive than equities, right? So I think this SIP culture, and we have seen, it's not that there has not been uncertainties or news flow, wars, and whatever we have seen, but that money flow keeps continuing. And I think this may surprise people in terms of how big this whole SIP would become. I think we are in the early stages, and as I said, a mutual fund. If you broaden this debate beyond equity, I think from asset allocation diversification perspective, are in a sweet spot. The last point here is that some of the customization advantages which alternatives offer now in a newer format, which is SIF, some bit of customization would now be available to offer to clients from the mutual fund standpoint as well. So I think the tax efficiency, the good intersection of flexibility, customization, and tax efficiency, I think now it's coming back to the mutual fund thanks to the regulatory moat around it.
Rajesh, I wanted to get your thoughts. Obviously, we've been talking about how the Indian markets have stayed buoyant because of the domestic investor support that has been coming in. Now, Jigar and me were just chatting the other day, and he was, we were discussing how the FII influence is reduced significantly, and therefore the impact on the market moves. What is your view on the fact that we are becoming, in a sense, more Atmanirbhar from a market standpoint also?
So we still have a long way to go.
Yeah.
If you see equity as a percentage of household savings, from 4% it's now closer to about 6.5%, 7%. In most developed markets, it's between 25 to 35%. So we had always been saying over the last 2 decades that Indian capital markets should ideally have strong flows into capital markets rather than lying in unproductive assets like gold and getting stuck in real estate and FD. And that, I think the industry has worked well. There's a lot of education, literacy, wealth managers, brokers, a lot that has helped develop this industry. Foreign money cannot ignore India. Last 3-4 years, interest rates have been high globally. And if you can sit in the US and get a 7% return on dollar and with leverage, you would not take too much of risk in markets that are considered volatile. So when the rate cycle turns, which it's already beginning to, you will find foreign money coming in. Of course, it will choose the markets based on valuation. There are other emerging markets along with India that offer a decent growth story. So money always chases growth. And given the inflationary world we are living in, with the amount of money that has got printed in the world, it's highly unlikely it won't chase equities, and within equities, which country to work on. So it's temporary, in my opinion. Even now, foreign institutions own roughly 21% of the market. Value terms, it's about 16-17% of the NSE 500. This will only go up. But having said that, I think it's a very, very positive trend of domestic flows getting into the market. The only point that we sometimes think about is that many of these SIPs have started in a very bull market environment. And I just hope that clients who are getting carried away by returns follow asset allocation and don't just over allocate in a specific asset class. That's the only advice that we always tend to give people. Whatever looks good, there's a recency bias and you continuously keep investing. Recently, it's gold and silver, so everyone's got into gold and silver. Surprisingly, September and October had the highest flows. So that's a typical bull market, right, where you tend to put everything in a specific asset class at the so-called peak. So you have to follow a discipline of asset allocation and just ensure that you're not getting carried away by what is seemingly looking good. That's all.
Because everything seems fine. Like you also mentioned that from a macro standpoint, probably India is at the best phase where it's been in a really, really long time. We are seeing, the banking balance sheets getting cleared up. We are seeing corporate balance sheets getting cleared up. Growth is picking up. Fiscal deficit is coming down. All of that, well said. But can we just sit without any concern right now? We have to be mindful and watchful of a few triggers aside from geopolitics that we've already discussed at length. But internally, is there anything that you are watching like a hawk to see if there are any variable changes where I will get sleepless nights and I don't want that?
I think, see, risk always comes from the source you don't expect, and it comes when you don't expect. So it's always, it hits you when you don't expect and from wherever. So I don't think one can always intellectually give a lot of answers that aisa ho sakta hai, waisa ho sakta hai. Sorry?
You can't anticipate.
You can't anticipate. I mean, very good sound, answers are geopolitical, political instability. All those are very standard answers. The only, I know that you can't model that risk at all, but two big risks which I see in the world, which could be very, very, one would be around the cyber attack, right? Which I don't think any of us can even predict what will happen. We have seen what recently happened with JLR, the entire, when many companies are getting attacked, and how do you model that risk? You have no idea about, right? Secondly, the nature of geopolitical warfare is also changing, from cyber to biological warfares to, different kind of warfare, right? Now, what shape it will take, who knows, right? And that part, we all can be focusing on what's happening on the border and who has how many missiles and how far it goes and stuff like that. But I think the warfares are changing. So in a world which, Ambassador described that very geopolitically uncertain, still the debate goes around whether COVID was a, accident or planned or unplanned. The jury is still out, but so same kind of things can happen. So, and you can't model that risk. You have to live with that risk. The only good news is that, like I was saying again, that our vitals of our economies are strong. So the analogy I give is that if vitals of my bodies are strong, viral attacks will happen. If my body is strong, I will be down with fever. I won't be in ICU. Same way, our economic vitals are very strong, right? The 5 vitals I said. Now, a tariff viral attack might happen, something viral attack might happen. When that happens, we are not fragile 5. We are not down as an economy big time. We will be sideways, will suffer for some time, will come back. So I think the only answer to that is, and good part about India is that the structural risks are not there. Tactical risk will always be there. It will always come from the sources you don't expect, right? And as Rajesh was saying that earlier, that I see the financialization of assets is very big trend. More and more money will flow. And as for your question on the foreign financial assets, I can tell you that, as long as there's a growth, as long as there's a honey, bees will come. So we have growth. There's only country in the world where there's a huge amount of sustainable growth over the next 10, 20, 30. Our demographics are so strong. So money will come. It's only a matter of time. And as that rate cycle changes and all, I think today our foreign holding is about 15, 16% come down from 20, 21%. Domestic, there was a number which we did that if India today at 6% of financial savings, if it only goes to 10%, over next 10 years, $2 trillion of additional financial savings will come into Indian, system.
But where is the avenue to put in that 2 trillion?
That also will, where was the $10 billion IPO happening earlier? Today it's happening, right? So rather than saying, oh my God, too many IPOs are there, we should, very good, too many IPOs should
Was
come.
it the largest number of IPOs? 327 IPOs.
Should be, because we have never seen this kind of flows also. So that is what is catapulting growth, right? So when money is available, goes into economy, it boosts the entrepreneurship. Today, why a lot of startups are happening in the country? Money is available. So availability of money, availability of risk capital, creates entrepreneurship, creates venture, people's ability to take risk, build businesses, right? And that happens. So capital markets are a beautiful instrument to boost economic growth of any country. And this inflow of financialization, what happened post Demon and post everything else, this financial assets which earlier were trapped into real estate and cash economy is catapulting the whole economic growth. And to my mind, that's the single biggest trend. So we should not, rather than asking when this SIP will stop, how long it will go. It's a very, very, very long trend. It is not stopping. Like it happened again, I go back to US, 401k continued for 20 years and still provides. So it is a very long trend. And I don't see, so there are lots of tactical risks which will come, but I don't see major structural risks.
The Howard Marks talks about the fact that the world never ends. It just fluctuates, right? If anyone would have invested in 2005 just 5 crores and just not done anything, just been with the index, including dividends, etc., that would have been worth 100 crores today. And in these 20 years, what all have we seen? If you think about COVID, it was like a third world war. The amount of people who died, the amount of economies that were shut down, but you still saw, it was a fluctuation and things came back. Asian crisis, global crisis, wars. So broad point is that the structural story of India, it's got re-rated. All the things that we spoke about are actually taking shape. If you see where we were 20 years back and you see where we are today in various areas of life, per capita income has crossed $2,800. Any country where it crossed $2,500 actually saw 2 decades of growth after that. We are at $2,900, and if you take the top 10 cities, we are upward of $7,500. If you look at digital infrastructure, absolutely top end compared to the world, what we have built. And on that, so many new business models have got created, which we never had. You take physical infrastructure, 162 new airports that have come up, roads, ports. So if you look at all that is going on, financialization of the economy, formalization of the economy, it's such a long runway that for the next 2 decades, it's going to be a golden decade. Now, how you can participate is really where every wealth manager should be focused on. Disciplined allocation. Equity by far is a superior asset class. It gives you the best post-tax compounded returns. But having said that, everyone can't handle volatility. So how do you create portfolios that have market neutral strategies, something in alternates, fixed income? So there's lots today. I mean, even the industry has matured to offer many clients so that we can manage risk and also you can enjoy the beautiful story that India offers.
Thanks, Rajesh. Jigar, I wanted to actually pick up the point that Vikas, he said, where there's honey, bees follow. But the last few years, those bees have been coming a lot of hot money. So it's not been sticky. So bees have not stuck to the honey. They've come and then they've gone back. So that has been something which has been, and now with that exposure coming down and with obviously more financialization of domestic savings and our own domestic investors giving that support, is that worry becoming less and less top of mind?
For one part, Devina, but I will see, just sort of bring out a small technicality here. Now, rupee depreciated against a depreciating dollar. If you look at the gauge of dollar against a vast array of currencies, the DXY index fell from 110 to 98. In conjunction, rupee should have appreciated because every other currency did, but it didn't, because I think September, October 24, RBI did some miscalculations and we paid the price for that. So to your question on, bees have come but not stuck, you want, when dollar is depreciating, you want to be in emerging markets. Money went into Korea, money went into Taiwan, money went into Philippines, but didn't come India or actually exited India. Picking up from the point what Vikas and Rajesh mentioned, a 5.6% household saving coming into equities, you extend it to 10% for a couple of years, you're talking about the SIP book rising to about 1 lakh crore a month. The counterpoint to this is that if you push in so much money, it leads to the revaluation of assets to a certain extent, but then the laws of physics take over, right? There is this concept of self-organized criticality. If you take the 5 and the 10 years sort of rolling return, so average out, I'm not talking a point in time number, the EPS and share price growth has always aligned. Take September 24, right? From peak to bottom, the small cap index fell 25%. India, Pakistan skirmish came way later, but the markets were correcting way before that. What was happening? What was happening was that, driven by so much money, the number of folios in small cap had gone up 5x from COVID until 2025 Feb. The AUM of small cap and large cap indices has completely aligned. When large cap's market cap is 3 times small and micro cap combined. So you push so much money, you're creating dislocations, and then self-organized criticality takes over. The indices fall 25-30%, and a lot of investors who were making hay when the sun was shining are now completely wiped out. So that is an incremental risk if you don't give an outlet. And I don't think India is in a position to give the outlet because there is no capital convertibility, so to speak. You're running a current account deficit, FIs are exiting, FDI net is 0. So Indians won't be allowed to invest outside. And you will have this bouts of optimism met with sudden skepticism, and then reasons will be known only later. So I think these cycles are becoming shorter. It's important that we keep an eye out on what we are paying to buy the asset that we are buying.
Which is, Ashutosh, a point to you. Now, when money comes in, and it comes in truckloads, you want to be in the best of assets, you want to be in the best of companies. But then the question of what price you pay for it, and then the valuation froth, and then obviously the drawdowns which come in when events like this happen. So how do you measure yourself when you are taking this kind of money in? Because mutual funds will not be able to stop that money from coming in.
Some ways, markets like nature's self-correcting mechanism, right? So valuations go up, supply of paper comes in, and which, in a high, perhaps the highest growth economy for next many years, India will continue to have demand for capital also from various businesses. So the supply is in a way good thing that they keep a cap on valuations. Foreigners have been selling, again, that has helped in terms of keeping the valuations in check. So I don't think valuation per se is a big challenge now versus they were 15 months ago, to be honest. The outlook for growth is much better than what it was 12 months ago. Things are actually falling in place for growth. And our understanding is that if growth comes, valuations takes a back seat. The problem for the
So
last
you
12,
pay more, you pay premium for growth.
you pay premium. Part of the reason I think valuation will always remain higher in India versus in the past is because the distortion which I just talked about, and many people don't talk about it. Equities are, government favorite asset class in some ways, right? I mean, it's taxed at such a low rate versus anything else, right? So more and more people, as they understand, will gravitate towards equity. The companies have also become, the balance sheets are very, very low, but the cyclicality of earnings or the balance sheet stress is much lower. And I think from now on, I think we think actually valuations are no more a problem. Growth is looking good from 1 to 2 years standpoint. And in a VUCA world, you can't focus beyond 2 years, to be honest. A lot can happen in a 2 year time frame. But things are actually much better now, both from valuation perspective and earnings perspective now. Earnings, in fact, in the quarter which has gone by, for the second quarter, has actually come better than what people expected. The second half is going to be much, much better thanks to the GST cut and interest rate cut and the income tax cut, right? So I think valuations are overhyped as a concern to my personal, and historical context doesn't help when it comes to valuation. Think of an index valuation. The only thing which is true about index valuation is that it's called Nifty, maybe PE ratio, right? But the thing with Nifty PE ratio is that the index called Nifty has completely transformed every 10 years. There's a two-third change which happens in the index. So I think it's a very lazy way to ascertain the, if I may say, the overheatedness or attractiveness of the market. Personally, I don't think valuation is a concern. I think there are very good risk-reward opportunities in the broader market, and broader market is corrected and is much cheaper now. Yeah.
Okay, I'll ask one last question and then I'll throw it open for the audience. And this is a question that probably is, I would expect it from the audience, but I'll just on behalf of the audience ask it anyways. So public markets were earlier the space where you got a chance to experience businesses and participate in their growth story after they became public. So till that time, only institutions who were able to, till private equity 10 years back came in and they started investing in companies a little earlier on. Now what is starting to happen is that access has opened up for a lot many more people. And people are not able to value it correctly. So what we've seen in the last few months or the past year with the listings that have happened and with the unlisted space sort of heating up, and then then the disappointment of the listing happens. What is the word of caution that you would like to give? And it's open to anybody, that when people have this kind of sudden access and they start considering unlisted markets to be comparable to public markets, how would you tread that path?
Let me take this. We had written a very interesting note on this about a couple of months ago. That I think, of course, there was a very good success story in unlisted space called NSE. People who got into earlier made a lot of money, and I think that kind of glamorized investing into unlisted stocks. But I think one must understand, and this is almost like a fad going on right now, that everybody, very often you ask that what's unlisted. Even if you say listed risk reward is better, but you have to buy unlisted because the perceptions got built that, but by and large, most people don't understand that unlisted price discovery is very opaque, right? We have seen companies like SDB Financial Services, Tata Capital, and many more, they got traded in the private market much higher than the listing price, 40-50% higher than the listing price. Now that prices will never come back. I remember Paytm, a very large investor, family office, bought it at 3,000 rupees. It IPO'd at 1,800 rupees. And when I asked that guy that why did you buy at 3,000 rupees, he did not know anything about, I mean, he did not know the proper valuation of the company. He did not know, how the, financial will play out, but it's just per share price. And same thing we see all the time in, in the investors. FOMO, because everybody is doing, and it sounds very nice to talk in parties and that I bought these shares and this happening short term, but most people can't get out. And see, we have seen many disastrous outcome where 100% capital loss has happened at Blue Smart and many Good Glam, and where money has got wiped out. Blue Smart raised 500 crore rupees, and in 6 months' time, it wiped out to zero. The fraud came out, right? Same way happened to Good Glam and many such companies, right? So investing into private is a very, very specialized job done by the private equity guys or a professional manager who have a lot of rights and whatever.
They have information.
And rights also
Yeah,
through the shareholder agreements, which retail shareholders won't have. And so we kind of wrote that, this is a very big fad going on. People are investing out of FOMO, and this will fade away. A lot of people have lost a lot of money. So we talked about multiply risks. Actually, risk is something what you understand what risk you are taking. Unfortunately, in unlisted, most people don't know what risk they are taking. It is just because, my neighbor did it, other family office did it, other investor did it, and like you kind of just chase that. And to my mind, that's a very dangerous path to walk on.
I'd like to add, in each asset class, there is risk of doing something which is unknown. In listed equity, why is it that very few people get into equities? Because when you start treating equities as an affair as compared to a marriage, which is getting into buying things you don't understand or know, out of the 6,500 companies listed, if you go below the top 500, 700 or 1,000, there are so many stocks which people buy, penny stocks, operator-driven stocks, derivatives, F&O. So even in equity markets, people lose more money than they should, and they keep blaming the asset class. Same thing in private. The difference, at least is in equity, if you're doing it in a proper way, you have enough and more financial information and knowledge to take the right call. In private, you don't get enough information. So you have to be extra selective. It is an asset class for institutional and ultra HNI investors only.
Yes.
But as Vikas was mentioning, many people get into it. Party talk, it's a FOMO that exists, and you have no idea what you're doing.
And investors who wish to access it should access it via the right route, through people who are professionals and who do this as a living.
And there again, it's an allocation. You cannot go beyond 10% of your portfolio, even for super ultra HNIs, we advise. So it's a trend that happens. It's not an India trend, it's global. Last 5 years, even in the US, most ultra HNIs have got into private. Institutions, the biggest of institutions, Harvard, Stanford, at 10 years back, their allocation to alternates was 10%. Today, it's gone up to 40% because the equity markets itself in the US are very, very large. But then they go through serious amount of homework, research, due diligence, agreements, etc., etc. So it's got its place, but it's very selective for high risk. And like I said, fixed income in India, people think it's not risky. In fact, we found in the last 30 years, at least in my experience, most accidents happen in fixed income when you chase high returns and you really don't understand the risk you are taking, right? So there are various products for different risk appetite, and I think that discipline always needs to be maintained.
Ashutosh and Jigar, closing comments from you all. Probably over the next 12 months or so, how does one navigate?
I think equity looks much better, to be honest. I mean, see, when markets underperform for 12, 13 months, so Indian market has underperformed the other emerging markets. The extent of underperformance is highest in 30 years. Now we have underperformed versus rest of the market. That means our valuations are more attractive to the foreigners. Vikas Bhai was just saying that foreign ownership of Indian equities have come down. Partly it could be because there's so much of AI trade globally which is going on. I think next year is looking much better in the form of both earnings, and maybe there is some fatigue in this whole AI trade globally. And that means that the interest towards India will again rise, right? So I think next 12 months, equities to me, looking much better than fixed income or maybe commodities as well.
Yeah, I would agree, except for the fact that I think see, like breaking it down in time period looks very alluring. Next 6 months what, next 12 months what. But I think we are now in a position that if you know what the ambassador said, the biggest risk today is say, tariff-related issues, policy level shifts, all of that are getting addressed. Then why just limit the thought to 12 months? Right? A discipline eats timing for lunch every single time. So I think we take a step back and say that we are not thinking 12 months, we are now thinking 10 years and 12 years. And that has a higher propensity to make you less unsettled than anything that you can come up with in any session.
Thank you very much, gentlemen. It was a great chat with you guys. I think we'll throw it open to the house. Dr. Raji.
Hi, great discussion. Thank you to all the panelists for making some very valid points. So a lot of thoughts and points that kept coming up in the discussion. I'd like to just touch upon them once again. So we talked about too much money chasing the opportunities that are there in India. Family offices, 100 million, $500 million, $1 billion plus, SIP flows. We talked about Japan 87 and 35 years of no returns. We talked about alternate assets. The dilemma that I face as an investor is, just knowing the history of financial markets, knowing the China not having delivered returns. When things get hyped up, generally the prospective returns tend to be flat or negative over long periods of time. And India seems to be hyped up at the moment in the global context, in terms of valuations, in terms of all the reasons that we've spoken about, and the arguments in favor of the secular trends in India, of course, are very strong. But the fear, of course, is that are we too ahead of itself? Are we, can the best of the returns be captured in? Because with billions of new money flowing in by domestic investors, family offices, SIPs, the flip side of that is there are, unlimited supplies of new paper as well, lens cards of the world, where again people don't understand valuations, and there is this tendency to overpay for growth, thinking that 1 or 2 years of growth will continue for 10 years, which never does, and therefore, and there are ample examples in the last 1-2 years itself, where let's say even in Calcutta, the wagon industry was almost treated like a sunrise sector, and they're all corrected by more than 50% in the last 1 year with flat growth. So the growth extrapolation by the markets and fund managers and investment bankers tend to be a little too hyped in the short run, and a lot of these growth businesses turn out to be, not such a secular growth story. So I just wanted some thoughts around that, and how should, because again, if you look at the last 1 year, as some hint that, all other asset classes other than Indian equities have actually outperformed Indian equities, whether it's global emerging markets, whether it's gold, silver, whether it's commodities, etc.
I'll try and answer that, sir. Before I do, can you tell me if you use an iPhone or an Android? I know it's a very unusual question, but please humor me for a minute. iPhone, right? So, okay, anybody with Android, if I can have by show of hands. Okay, so, iPhones, you can't use Truecaller. The simple reason is that the way a Truecaller works is that if you're using an Android, the Truecaller app intercepts the call before it hits the device, it runs it through its servers and says, 80% of the people have stored this number against this name, and therefore there's a good probability so and so person is calling. In Android, Truecaller doesn't work because the Apple ecosystem will never give you the controls of this, because if you can intercept a call, you can intercept a message, in which case, your entire credit card data is saved on the browser, so your two-factor authentication has become zero. Correct? So clearly, as a privacy setting, Apple or iOS does a much better job. Now, if you're in the market to buy a new phone, if say the Samsung is at 50,000 rupees and Apple is 70,000 rupees, you will say, okay, I might upgrade. If Android is 50K and Apple is 5 lakhs, you will say, okay, I'll keep my credit card limit at 1 lakh rupees, right? It doesn't matter. So as consumers, we are very, very categorical on deciding what the value versus price proposition is. You mentioned the shares of a few of these sort of companies that corrected 50%. When was the last time we sort of checked what the implied valuation of any of these businesses? So I think at the end of this long sort of monologue, I'll say that paying, knowing what you're paying to buy the growth, value, whatever proposition becomes fundamental to almost all investment decisions. So I think it's not so much dependent on sort of what the market conditions are. There will be sector and stock level cycles across the board, but I think it will all boil down to knowing what you are paying to buy the business you do.
Amitabh, I will only add one. We have had chat in the past on this, but see, I think India, we have not seen a very long, sustainable, uninterrupted period of growth because we had a lot of structural weaknesses in this, right? And I know that today, we spoke about it, that the structural repairs have happened. So it becomes very hard to fathom for us that how long this growth will continue, right? But the fact is that in 2002, total corporate profit of India was $8 billion. Today we are $170 billion. 20x in 2002 to now. Right now, in this period, you imagine all risks which have happened, can happen: UPA 1, UPA 2, global financial crisis, 3G scam, coal scam, fragile 5, demon, GST, ILFS crisis, pandemic. आप जो सोच सकते हो, उसके बाद भी we have gone 20x. In today, 5 companies have more profit than $8 billion individually, right? So we very tend to underestimate long term. I am not making a point that there are no short term. There will be periods like last 1 year we had hardly any return, but in this period also, there are stocks which have done phenomenally well. So I think it's about understanding your investment philosophy. If you think that wagon stocks are kind of outpriced, get out of that. And I think so. In my opinion, actually, we don't invest into stock markets. We invest into companies. And I think making a call, looking at the index, and then deciding on, in my opinion, is not a great idea. And I think one has to remain. Asset allocation can change up and down, but eventually you are investing into good quality companies, good quality businesses, hopefully at a reasonable price. And if you don't understand the price, don't invest. I believe that there are always good quality investment opportunities there. They might not perform in the short term. हमको हम जब वो टिकट ले रहे हो तो लगता है मेरी लाइन सबसे कम धीरे चल रही है, बाकी सबकी तेज चल रही है. वो typical human psychology है, right? And then we keep changing the lines. That does not get you the fast ticket, right? But so there's a lot of, in my opinion, human psychology play at investing. And you are a smart investor, so who am I telling? But point is that too much skepticism, that because we all have scars of the past, that actually, in my opinion, impacts our ability to remain committed to this once in a lifetime transformation which is happening in India.
Hello, excuse me. This is the question to Mr. Jigar. Did you say that you cannot install Truecaller in iPhone? I didn't hear properly.
Right, sir. So you can install a Truecaller in iPhone, but it will not work in the same way it does with Android.
So where it works better?
Why would it work better?
No, where it works better, Android or iPhone?
Android, it works better.
So is it better to uninstall Truecaller?
Yes.
Because I have it, so I might face problems. So I want to know.
You can, let's say if you don't have a number saved in your phone,
Yeah.
you can put that number in Truecaller and find out who the person is, but it will not tell you real time who the person calling is.
Yeah, just now a call came and it was saying that something spam, so it didn't come to me actually.
Yeah, exactly, sir. My
Okay.
point. Thank you.
Okay, now,
I have three questions on equity.
okay. Now my question,
Uh, uh, I have three questions on equity. Peter Lynch, founder of Magellan Mutual Fund, believed that the best ideas come from what we already know, the brands we use, the shops we visit, and the products we see people buying more of. His style was about finding great businesses early and holding them long enough for the story to play out. Do you think this is a good long-term strategy? Next question is Ashok Jhunjhunwala had a similar long-term strategy, but a short-term strategy too, like stop loss and others. What is the best short-term strategy according to you? Investing in bonus stocks? Last question is Indian derivatives market is the world's largest by volume of equity derivatives contracted. The figure for October 25 is rupees 506 trillion. How and why is Indian derivatives market so big?
Yeah, I mean, so I mean, to your first question of Peter Lynch, yes, I mean, investing is commonsensical, basic thing. You know, if you buy good companies, good run by good management, essentially, three things are only three things. Holy grail of investing is what? Good business, good management, and reasonable valuation, or right valuation, right? So that applies everywhere in every cycle. Now, how you understand each of this is that is where the art and science part of lies. So I think that is true in Indian context as well, and that will probably true in every context. I think second was derivatives volume. I guess so. India is a very highly liquid derivatives market, thanks to the lot of innovation by the exchanges and short-term expiries and all. I think India has that very short-term gambling mindset, and when you make products available so easily to wider population, obviously people tend to trade more. Korea was such market earlier. I think India has overtaken that. Korea also has a low price options market and all those things. So I think personally it is very wrong. I mean, we should not have this kind of easy access to unqualified investors to trade derivatives, because against such people, I mean, the qualified professional traders wins against the very wide retail. That's the reason SEBI publishes that 90% of the investor or 95% of the investor loses money. And I think there's a lot of debate happening that what to do and what not to do. I'm sure there'll be some measures which will be taken in the next 6 to 12 months or whatever. SEBI is very acutely aware about it. And I think this is a point of concern because a lot of people are losing money on that. So yeah.
Slightly on that lighter note, market is like God. हिंदी में बोले तो भगवान से आप जो मांगो वो दे देता है. Problem with market is that lot of people look for excitement in the market. तो उनको केवल excitement मिलता है. I think the people who are in the derivatives are actually looking for excitement and not for the proper wealth creation. I think so. There's so much of social media influence and peer influence, but this is not the road to wealth creation. It's for fun and maybe for adventure to a very large extent.
I know we are all enjoying, and we would like the question answer session to continue, because I mean, this is very, very dynamic situation. Things evolve and you want to know so many things, but all good things have to come to an end. So I think we are really thankful to all our experts for sharing their knowledge, very, very useful insights. And I'm confident that audience today here has benefited a lot from your deliberations, your interventions. And of course, we are thankful to Devina, who made the whole discussion very, very purposeful. And Before we close, I will now request President of ICC to please come up on the stage and present a small token on behalf of Indian Chamber of Commerce. And let's give a huge round of applause to all our experts for the excellent session. And lastly, I will also thank Mr. Agarwal, because this was his idea, his initiative, and he thought of holding an interesting session like this. And of course, we are thankful to Nitin for putting together the whole session. So I think a big thank you to all of you. We can have a group photograph. So with this, we come to an end, and you are all invited for lunch. Thank you.
Thank you.
Great session.